December 15th, 2025, four words appeared in a classified briefing that sent shockwaves through Washington's financial corridors. China stops silver exports, not reduced exports, not limited quotas, complete termination. Effective immediately, the world's largest silver supplier had just weaponized a metal most Americans don't even think about. While Wall Street debated interest rates and inflation targets, Beijing quietly cornered 70% of global silver supply and then pulled the plug. The consequences are already cascading through markets in ways that make 2008 look like a minor correction. But this isn't about silver, this is about the systematic dismantling of dollar dominance, using a strategy so elegant, so mathematically precise, that by the time Western economists figured it out, the trap was already set. China didn't just restrict silver exports on a whim. They executed phase 3 of a multi-decade plan to destroy the dollar system from the inside out. And the beautiful irony, we helped them do it. Think about what happened to your smartphone in the last 5 years. Faster processors, better cameras, longer battery life. Every advancement depends on one critical element that conducts electricity better than anything else on the periodic table. Silver. Your car's electronics? Silver. Solar panels powering the green energy transition? Silver. The 5G infrastructure connecting our digital economy? Silver. Medical equipment saving lives in hospitals? Silver. Defense systems protecting our borders? Silver. China understood something our policymakers missed entirely. Control the materials that power modern civilization, and you control the civilization itself. Here's the trap they built. For 2 decades, China flooded global markets with cheap silver while simultaneously building the world's largest manufacturing base for everything that requires silver. Solar panels, electronics, electric vehicles. They became both the dominant supplier of the metal and the dominant producer of everything that needs it. Western companies celebrated cheap input costs and record profit margins. Wall Street applauded China's contribution to global supply chains. Nobody asked the obvious question. Why would a rational economic actor sell their most strategic resources below market value for 20 years? Because they weren't selling. They were setting the stage for the largest wealth transfer in human history. While Western investors chased paper assets and digital currencies, China accumulated physical silver on a scale that defies comprehension. Conservative estimates suggest they've stockpiled over 30 billion ounces through state-controlled mining operations, industrial recycling programs, and strategic imports disguised as manufacturing inputs. That's enough silver to satisfy global industrial demand for 3 years. But the real genius wasn't just accumulating the metal. The real genius was timing the cutoff. January 1st, 2026. New export restrictions went into effect that require Chinese companies to obtain state approval for any silver shipment leaving the country. Only firms producing over 80 tons annually even qualify for consideration. The message couldn't be clearer. China's silver stays in China. The immediate impact was surgical and devastating. London's silver market, which depends on Chinese supply for price discovery, saw spot prices gap 40% in the first trading session. New York's COMEX exchange suspended silver futures trading twice in 1 week as delivery notices spiked beyond available inventory. Industrial buyers from Germany to Japan scrambled to secure alternative supply sources that simply don't exist at scale. But this is where the story gets interesting, because China's silver strategy isn't happening in isolation. It's the industrial component of a much larger financial warfare campaign targeting the dollar's reserve currency status. While American politicians debate debt ceilings and spending bills, China has been systematically building an alternative monetary system that doesn't need dollars, doesn't use SWIFT payments, and doesn't depend on Western financial institutions. The numbers tell the story. In March 2023, Chinese yuan settlements exceeded dollar settlements in China's international trade for the first time in history. By March 2024, over 52% of Chinese payments were conducted in yuan, while dollar usage dropped to 42%. This isn't gradual de-dollarization. This is aggressive substitution happening in real time. And it's accelerating because China's trading partners are being forced to choose. Accept yuan payments for Chinese goods or find alternative suppliers that don't exist for critical products. The BRICS alliance provides the infrastructure for this transition. 10 countries representing 45% of global population and 36% of world GDP have committed to reducing dollar dependence through local currency trading arrangements. Russia and China now conduct 90% of their bilateral trade in rubles and yuan, completely bypassing dollar clearing systems. India and China are negotiating rupee-yuan swap agreements for energy purchases. Brazil is accepting yuan payments for commodity exports. The dollar's role as the universal medium of exchange is being systematically dismantled one trade agreement at a time. Silver becomes the enforcement mechanism that makes this transition irreversible. When German solar manufacturers can't source silver through traditional Western markets, they're forced to establish yuan-denominated purchasing agreements directly with Chinese suppliers. When American electronics companies face production shutdowns due to silver shortages, they have no choice but to accept Beijing's currency terms for continued access to critical materials. Each forced conversion weakens dollar demand while strengthening yuan adoption across industrial supply chains. But the most devastating aspect of this strategy hasn't even begun yet, because China's silver restriction is just the opening move in a commodity dominance campaign that extends far beyond precious metals. China controls 97% of rare earth production, 80% of lithium processing, 60% of cobalt refining, 85% of permanent magnet manufacturing. The silver cutoff was just the beta test for a comprehensive resource stranglehold that could paralyze Western industry within months. Beijing has spent 30 years positioning itself as the indispensable supplier for every material that powers modern technology. Now they're converting that industrial dependency into geopolitical leverage with surgical precision. The timeline is accelerating because China recognizes the window is closing. American reshoring initiatives, European supply chain diversification, and Western sanctions have created urgency in Beijing to act before alternative sources come online. But here's the mathematical reality that makes their strategy nearly unstoppable. Building new mining operations takes 7 to 10 years. Establishing processing facilities requires massive capital investment and environmental permits that Western governments struggle to approve quickly. Creating entirely new supply chains for critical materials isn't a policy decision, it's a decade-long industrial undertaking. China doesn't have a decade. Neither does the dollar system they're targeting. Federal debt approaching $40 trillion, unfunded liabilities exceeding $200 trillion, and interest payments consuming 20% of federal revenue create fiscal constraints that limit Washington's response options. Every month Beijing delays critical material exports is another month American manufacturers lose market share to Chinese competitors who face no supply shortages. Every quarter Western companies spend searching for alternative suppliers is another quarter Chinese firms capture additional global market share in finished goods production. The currency implications compound the industrial pressure exponentially. When Ford can't source silver for electric vehicle production, they're forced to either halt manufacturing or establish yuan payment systems with Chinese suppliers. When Tesla faces battery material shortages, Beijing offers guaranteed supply in exchange for long-term contracts denominated in Chinese currency. Each forced conversion doesn't just reduce dollar demand, it creates structural yuan demand that becomes embedded in corporate supply chains for years. This is economic warfare disguised as trade policy. China isn't just restricting exports randomly. They're targeting specific materials that create maximum disruption with minimum Chinese economic cost. Silver represents less than 2% of China's export revenue, but supports over 40% of Western industrial production through electronic components, solar infrastructure, and automotive systems. Restricting silver exports costs Beijing minimal lost revenue while forcing massive Western supply chain reorganization that benefits Chinese manufacturers competing in the same markets. The Federal Reserve faces an impossible choice: raise interest rates to defend dollar strength, which crashes an already fragile economy dependent on cheap credit, or maintain accommodative policy while watching dollar purchasing power erode as trading partners abandon greenback settlements for yuan-based arrangements. Either path accelerates the timeline toward monetary system breakdown that China has been engineering through commodity control. But the most dangerous aspect of this strategy remains hidden from public view, because China's resource restrictions aren't just about forcing currency transitions. They're about creating the conditions for a new monetary standard that restores hard asset backing to international trade. While Western economists debate inflation targeting and yield curve management, Beijing has been accumulating gold reserves exceeding 2,300 tons, with undisclosed silver stockpiles that conservative estimates place above 30 billion ounces. These aren't just strategic reserves. They're the foundation for a commodity-backed trading system that could emerge when dollar credibility finally collapses under unsustainable debt dynamics. China's Belt and Road Initiative has already established yuan clearing arrangements with over 60 countries. The BRICS payment system processes billions in local currency transactions monthly. Resource export restrictions create the forcing function that compels Western nations to either accept Beijing's monetary terms or face industrial production shutdowns that destroy economic competitiveness. The endgame becomes clear when you connect the pieces. China controls critical materials. China offers guaranteed supply through yuan-denominated contracts. China provides alternative payment infrastructure through BRICS and bilateral arrangements. China backs its currency with massive precious metal reserves. When the dollar system finally breaks under debt sustainability pressures, Beijing offers a ready-made alternative that Western economies will have no choice but to accept if they want continued access to materials that power modern civilization. The trap is mathematical. The timeline is accelerating, and the outcome becomes more inevitable with each passing month that Western policymakers treat this as a trade dispute rather than the systematic destruction of American monetary hegemony. Because China didn't just restrict silver exports, they demonstrated that resource control trumps military power, financial sanctions, and diplomatic pressure when survival of industrial civilization depends on materials controlled by your adversary. The question isn't whether this strategy will succeed. The question is how much damage Western economies sustain before acknowledging the new reality Beijing has created through decades of patient industrial positioning. The pieces are already in motion. China's silver export termination wasn't an isolated policy decision. It was the signal that the transition phase has begun. While Washington scrambles to understand supply chain vulnerabilities they ignored for decades, Beijing is systematically converting industrial dependency into monetary dominance using a playbook written over 30 years of patient positioning. You're watching the end of an era unfold in real time. The Bretton Woods system that made the dollar the world's reserve currency is being dismantled not through military conquest or diplomatic negotiations, but through control of the physical materials that modern civilization cannot function without. China understood what American policymakers missed. In a world powered by technology, whoever controls the elements controls the economy. The mathematics are unforgiving. The timeline is accelerating, and the outcome becomes more certain. Each day, Western leaders treat resource warfare as a trade dispute rather than an existential threat to monetary supremacy. Because when the dollar finally loses its reserve status, it won't be because China attacked our military or crashed our stock markets. It will be because they convinced the world there was a better way to conduct business, backed by the one thing paper currencies can never replicate: physical scarcity. The trap is closing. The question isn't whether it will succeed. The question is whether you'll recognize the new reality before everyone else scrambles to adapt to a world where Beijing sets the rules and the West plays by them.